Good evening and welcome to Beyond the Numbers, coming to you live here on the JoyNews channel. And today on the show, consistently the conversation has been, what is the real state of the Ghana cedi? Just recently, the president himself was analyzing and projected a 5% per annum depreciation of the currency. Already, the currency who was attained as the best performing currency in 2025 first quarter. We started seeing the depreciation subsequently, and some have said it's just a twitch. But the truth is realistic, and how effective can the government maintain 5 cedi mark in depreciation per annum? Is it realistic? Could we do better based on the performance of the economy? And that is what we're going on the numbers right here with my colleague who is standing by to break in the numbers. Isaac, it's good to have you.
Yes, I mean, Winston, that is the 5% target per annum that the president spoke about. And in fact, we've been trying to get some of this, forward-looking statement, and when the president met the media or the press, he said that, well, we've seen or we've gone through months or days of appreciation now. We've had some blip in terms of depreciation, but he believes that their target is around 5% depreciation per annum. And we know the history of the cedi. Over the last 3 or 4 years, the average annual depreciation has been around 15 to 20%. In certain years, it has actually gone overboard in terms of depreciating more than 20% in a fiscal year. But the president said that they have done their own analysis, and that is what they are looking for. He was actually the first person. He's given 2 indications, right? The first indication he gave was the fact that he believes that the level of the cedi should be between 10 and 12. And he was the first person to give us that indication. The cedi has left this range. Bank of Ghana's own quotation is around 12 cedis, 12 pesos at midpoint. And if you go to the commercial market, you can get as high as more than even 13 cedis to the dollar. But he has spoken again, and he says that, well, in spite of all of this roller coaster, we are aware of the situation. We've been analyzing, and per the data we are looking at, this is our target for the year, Winston.
It's an interesting projection. We've already started seeing 13% depreciation in the currency, and that has given us a tag that basically tells us we are the worst performing currency based on analysis that Bloomberg did recently, and that many have said is quite debatable considering the factors. But the same remix that were used for the best is the same remix that was used for the worst. However, it appears that due to the changes that have been witnessed so far, businesses are decrying its impact on the operations. Initially, when the cedi started appreciating, the first thing we had to assess, which we made a report, subsequently has to do with its impact on our debt stock, which reduced by over 10% and giving us a positive outlook. Subsequently, we saw the rating agencies coming through because we were able to fulfill our debt obligations subsequently, and these gave a positive outlook and sometimes gave us a very positive rating in terms of how the international community looks at us. And that gave a signal to the president where he started going around countries trying to negotiate for investment into the country. So he had a very good back home domestic outlook, and therefore sending it was quite viable. But we in the market analyzing the numbers tells us that indeed, although we've seen some positive indication the first quarter, recently the release of the GDP figures for the second quarter tells us that those potholes, those fundamentals that were booming in the first quarter kind of saw a very serious contraction. Basically, the mining and quarry sector that were boosting the economy in the first quarter, all of them are contracting, including oil and gas, which contracted by 5.2%, with the quarrying sector contracted by 0.5%. So it tells you that there's a lot of work to be done. The gold bond was a very viable conversation in the first quarter that is supposed to boost the outlook, especially looking at the current gold prices on the international market, projected to hit about 5,000 in 2026. So these are key optimistic projections that the government had hopes on. But still, the fundamentals and the policy structures from the central bank with the monetary policy adjustment, all of them gave us some kind of skepticism that has to do with where we're supposed to be in the latter part of this year. In
fact, you remember that famous statement from the former President Kofi Agyei, who says that Sika Mpedede, right? And it's the same thing with the cedi. When there is a lot of negative speculations about the cedi, it doesn't really like that. It will react and it will depreciate. The same way, if it has positive sentiment around it, that's the same way it will react. This is a president who, finds nothing wrong with talking about depreciation targets and exchange rates. He's very open. And many have said that media encounter he had, although many said that on Galamsey, they scored him, with very, very low mark. But how he answered questions around the cedi showed that he knew what was going on. He has sat within meetings. He had called those who matter in terms of, solving this problem. And he seemed to be informed, especially where he wants to get to and the target, especially what he's been informed, from the finance minister and then the BOG board. But there was something that we saw. I mean, for the first time, he's the first person to come out and say that this is our target. Why is this important? Because somewhere in May, the Bank of Ghana boss had told us that, well, we don't have any specific rate that we are targeting and we are working towards. He sort of gave an indication that we are allowing the market to, determine what will go on in the space and all of that. But the president said, well, that may have been possibly the position somewhere in May, but a lot has changed. And we have seen what is going on, the roller coaster and all of that. So we have a 5% target at the moment. And many have said that, that is what the president is saying. But some months ago, the BOG boss said that we did not have any target that we were working towards in terms of depreciation or appreciation. He believed that the market should interact and all of that. But the president also made a certain, frantic revelation there, during his encounter. And he said that, if he recalls, he knows that the BOG, when the cedi was appreciating, was intervening. And now they have stopped. The question is, why has the Bank of Ghana stopped? The president says that there are a lot of, structural issues that's not allowing the BOG to intervene and we getting the positive outcomes of it, to the extent that you intervene and provide monies to the commercial banks to aid in people who want money to import and all of that. But at the end of the day, these monies fall in the hands of the wrong people. People tell you that they are using the dollars to go and import. They go and it will show you the figure very soon. That was the president's, concern that it is. Well, I got a feeling that he was like, well, there's nothing wrong for the Bank of Ghana to intervene. But when we intervene and the money ends up in the wrong hands, you don't expect us to still be in the market to throw away hard-earned dollars for people to just keep and speculate around. And many have said that, well, that means that ties in with what the governor said some time ago, that it is not a sin to be intervening in the market. But we've seen that there is a clear target now. So how do you achieve that 5% target without allowing the Bank of Ghana to come in and the market forces to possibly, achieve it? Because already, if you do the math, we are currently around 21.3% year-to-date appreciation. It simply means that we are on track. For us to even get about 5% depreciation at the end of the year is some long way ahead. It will be difficult, because already we are on a very good track. For us to get on a negative track of depreciation, for us to even fall to 5%, many have said that, well, this is, way below the belt in terms of setting a realistic target.
For the first time in a long time, we've seen the vociferous nature of the central bank consistently killing speculations with narratives that align with the objectives. And that has been what has been reflected since the first Monetary Policy Committee meeting, that possibly the sentiment and the reflection of the economy were placed in the open for us to understand. And we've seen the governor always on each platform that he had, lamenting and putting out that indeed it is time for us to enforce some policy measures, including the outlook of the forex, how dollarization has become a key impediment to most of the policy stance of the central bank, and that was what has been going on. He said that indeed you can't be selling goods, pricing goods in dollars, because he named the real estate sector and some key sectors that have consistently been doing the same, including hotels and other sectors that are thriving based on the exchange rate modalities. And this has been going on for quite some time now. And one very key development that has been happening behind the scenes is the operation to the black market systems. We know the governor auctions most of the auction periods for dollars. The oil sector needs dollars to ensure they are able to import crude into the country to sell to the OMCs. We understand these operations are critical to ensure consistent supply of these critical necessities for economic to run smoothly. But there are instances where most black market operators buy or get access, or some of these FX find their hands into the black market, and these black market operators basically sell them outside the shores of Ghana to make profit due to forex differential because of the lack of access to information that has to do with where the dollar is going to end. So most people count on the falling dollar, depreciating dollar, to ensure they can make ample profit. But nonetheless, these are market dynamics that fall into place. Although we can have a policy, but still there are people who find their ways around.
Well, Winston, many have said that, well, 5% depreciation target. That will mean that where we began the year, which was, I think, somewhere around 14 cedis, 70 pesos.
Yes.
For us to even get that 5% depreciation rate, if everything goes wrong, it means that the cedi must depreciate to about 15 cedis, 20 pesos, or 15 cedis, 30 pesos, or 10 pesos. And many are asking, if that is the target, I mean, if all things go wrong and we find ourselves in a very difficult position, that is the target of the president, saying that the whole year we shouldn't see the cedi depreciating by that percent. If you look at this graph,
yes,
it tells you how easy it is to achieve this target, because already you have 5.34% depreciation in the first quarter. Then you have a whopping 50% appreciation in the second quarter. Then this is the third quarter, which is giving government a lot of headache, where depreciation has been around 14.77 per the latest data we are getting. If you sum all of this already, you are more than 20, you are into a net appreciation of, let's say, about 20% or 21%. If you do the math in terms of adding commercial rates and all of that, that's about 30%, or even between 20 and 30%. This is the last quarter left, right? For us to maybe, the worst case scenario, get that 5% depreciation, it means that the cedi must move by the end of the year to somewhere around 15 cedis, 20 pesos for us to possibly have that kind of depreciation. It simply means that by the end of the year, it is likely that we will have an appreciation or a cumulative appreciation instead of a cumulative depreciation.
Absolutely, and I like the way you put it, that certainly these are numbers that tell the story.
Yeah.
And basically we understand that the government has decided to embark on a big push. We saw the recent launch of the 24-hour economy policy. Just today, there was a strategic meeting concerning the 24-hour policy with the central bank, with the government, and also key players that are going to look at how it's going to enforce. And that is critical because monies, we need more FX to push into those sectors. We understand that the 24-hour economy, most of the optimism of that policy, a big push, is going to come from the oil sector. And that is one thing the president made mention of, that in terms of budgeting, the funding is seriously going to come from that sector. And if we are looking at how the sector has contracted with little investment that has come in over the last 5 years, and this, the conversation about ownership in some of the key mining sectors, and conversation about the reduced investment in some of the key mining sectors, and all these conversations, the external markets are looking at this. Investors are looking at this, and they are measuring the sentiment. And I've had conversations with key investors saying that although the government is trying to put sectors in place, if you look at both Cote d'Ivoire, Togo, Burkina Faso, if you look at the dynamics of investment, people will probably choose other countries because of how unpredictable nature of economy has been. And these are key issues that nations are looking at. But I believe if we go into the last quarter of this year, there is certainly going to be seasonal changes. FX to diaspora will come through.
Yeah.
They are also looking at the big burgers who come to town December.
Yeah, that's a lifeline moment, right?
Exactly. And most of the trade investment are going to happen between now and the last month of next month. And these are going to tell you how much is going to be in the economy before the first quarter. And mostly in the first quarter of the year, trade deals are going to manifest. All of them conclude between November, December. But serious business happens in the first quarter. And that was reflective in the depreciation we experienced in the first quarter of this year. And if you look at the numbers seasonally, it doesn't really change. And these are good reflection because then there isn't much transaction going on. But now we are going to be testing these numbers based on the outcome of most of the government's policy, which certainly may go either positive or negative going forward.
Well, talking about government policy, remember when President Kofi Agyei was like, there will be no haircuts, but there was haircuts, right? Making that statement, a lot of foreign investors lost confidence in the Ghanaian economy because that was the first gentleman of the land. He gave them a very big assurance that there will be no haircut, and there was haircut. Here lies the case. The first gentleman of the land who has access to all level of data and advisory and intelligence and all of that. He said, I have spoken to the finance minister, the Bank of Ghana governor, and they have told me that the city's natural level is between 10 and 12. That is a very defined range that the president gave. Now the city has left that range. Do you think that this kind of assurance that the president gave or that information he gave out and what is currently happening will have any form of impact in terms of, people are going to speculate around and say that, well, that was what the president said. He was very confident about it. He has spoken to his finance minister and his central bank governor, and they had given him that range. But now it looks like things are not really going on well because imports are increasing and all of that. Do you think that investors who definitely watch this show will have some form of doubt in terms of how the control we have in terms of how much goes into the market to actually support our forex, and the fact that mainly the Bank of Ghana has stepped back simply because there's a certain headmaster behind the scenes, which is the IMF, saying that, well, we don't agree with your footprint in the market. Allow the market to interact with itself. Allow natural level to be achieved. Do you think that this is a clear indication that we have lost possibly maybe a sovereign control of what we want to do in terms of our exchange rate market, and maybe currently we are doing the bidding of development partners who possibly are in our country to do assessment, and at the end of the day we'll get disbursement?
For consistently, anytime we are out of IMF coverage, we tend to have a very serious challenge with our fiscal outlooks, and consistently, fiscal consolidation has been the key fulcrum of the IMF conversation. And over the years, we've seen our operations under IMF has kept us in check. We are not expired. We have limited expenditure outlook. The central bank's financing of governments consistently has been limited, basically by 5%. And this outlook gives us some sentiment. The fear is in 2026, whether we are going to fall out of that dimension. Are we going to return back to our earlier habits? And if you look at the numbers which the governor has said, look at the numbers. Whenever there are changes, we can decide. He reiterated in most of his conversation that the real effective exchange rates, and this, he said, is what they are looking at.
Yeah, that's what they look at.
That's what they look at, exactly. And this will tell how the market will react. And certainly, the market is reacting differently. If you look at the data released by Statistical Service, it tells you that if you look at the services sector, which increased by 9.9% in terms of growth in the second quarter of 2025. It tells you that the key sector that grew in the service sector was the financial sector, insurance sector, and these sectors, you can see, are not sectors that basically are into trade, and basically they are sectors that focus on multiplier effect of funding or investment that are key. The agri sector experiences a marginal growth, and these sectors that are supposed to reflect in the life and savings of individuals are not seeing much boost. Right now, everyone is looking for opportunity to where to hide or multiply their investment. that is into creating a conducive environment for growth, and where the city will range is a very important outlook for the government. The government must protect the currency, because other than that, export becomes expensive subsequently. But there's also another dynamics people are watching, because we are here nearing December. The central bank governor may say, although we intend to keep the city somewhere, there's a need to balance the outlook for not just the domestic, but for international trade.
Well, the president said where that balance will be. He's not so sure where it will be, but he said, I'm not the central bank governor.
Yes.
But definitely we know that Dr. Siama is also looking at it, because he will be a bit worried at the moment, because there's a lot of pressure from importers who are saying that, well, we leave our monies with the central bank. It takes a long time before some of us will get the dollars. Some will even send in the request. They might not get the dollars and all of that. But the president said something that, for me, is very important, which is the fact that he said they've done some analysis within the last 4 years, and about $42 billion left the country to bring in goods as import. This money's left the shores of Ghana, but they never return. The question is, I mean, how do we even close such loopholes to the extent that it makes it so difficult for Bank of Ghana to strategically intervene? Because it looks like Bank of Ghana has the money to intervene at the moment, because this inflow from gold board, remittances, gold, for instance, cocoa, for instance, we learned there is a 4 billion waiting for us in terms of, forward sales and all of that. All this money is coming in. World Bank has brought in $360 million. We are nearing another IMF tranche and all of that. It simply tells you that even if you look at our international reserve position.
Very good.
Very, very positive. But at the moment, Bank of Ghana is tied. I mean, their hands are tied, because you can intervene, all right, but you are not so sure that this money will land in the hands of the right people who will use it to drive growth, but not to speculate. That has been the problem of the Bank of Ghana, where, for me, this figure is very, very big. $42 billion. That's according to the president, that it left the country to bring in goods. These monies have gone. Nobody can trace them. Nobody knows when that corresponding import will come. But that money has left. And in fact, if we do the projection, Winston, we say that already in the first half of the year, our import bill has exceeded $8 billion. And our projection is that by the end of the year, we could hit some $16 billion. And the Bloomberg report also cited the fact that the current increase in imports is rather, it's posing a lot of challenge to the city. And the president said that, well, when the city reached its best level at $1 to 10 cedis, 25%, everybody was rushing to import because import became cheaper. How do we balance this? And in fact, how is this even going to pose as a big burden? Especially, I'm looking at the first quarter, where sometimes things are a bit dry in terms of, the fiscal nature.
Huge investment in domestic industrialization. Let's prioritize our export differentials and try as much as possible to support.
24-hour economy has accelerated export development in it, right?
Yes, and as soon as possible, if you want to, this is the target. If government wants to ensure that the import bill comes down, then there's a need for them to ensure that domestically companies or factories or industries that have that expertise are prioritized, and that investment are concentrated instead of having demarcated let's say, investment, because it appears we may have factories in certain regions that do not have the resources closer to them, and these are key conversations. We consistently have been exporting raw in nature. Right now, the dollar is strong in the international market, and that brings a lot of burden on domestic importers, basically, and this is a conversation that should not just be a conversation, but should go into implementation and strategy. Right people at the right place and the right policy with the right time. And that,
yes. The Bank of Ghana says that it's not a sin to intervene, but at the moment, because of the loopholes in our economy, it's becoming so difficult for the Bank of Ghana to intervene. But per what we have looked at, it is realistic to actually achieve that 5% target that the president has set, because already we are in big appreciation in terms of if you net the two. We are, studying the numbers to see what will happen at the end of the year. But so far, that is the projection of the president. This has been Beyond the Numbers with me, Isaac Kofi Agyei, and
Winston Tackie. See you same time next week. Enjoy.